According to minutes from the last month's Federal Reserve meeting, Fed officials still see upside risks to inflation. They said more rate hikes could be necessary to tame rising prices. Roger Ferguson joins us now, former Fed vice chair and a CNBC contributor. Roger, that was the headline. That was the takeaway. But I couldn't help. I was reminded of the late, great Prince. The doves, there were a couple doves that were crying a little bit. And I heard that, too. And I'm wondering, I think it's good because nobody knows everything. And it's good that it's not everybody is there just to nod and in agreement. What do you think the doves see that maybe the rest of the FOMC they don't see? What do you think they were looking at?
Well, first, I think you're right to point out that while the headline was pretty hawkish, there were a range of views that came through. I think what the contrarian point of view is that there's been quite a bit of tightening already in the system. There's still some uncertainty about credit tightening coming forward, and maybe it's time just to take a pause to let all of this work its way out. And there are a couple of places where that kind of sentiment came in around the risks being maybe a little bit more balanced and not all on the inflation side. So I think that's what the doves are seeing.
The 10-year might do some of the work for the Fed at this point. That could cause, I don't know, the housing market, mortgage rates. A lot of things are pegged to that. So maybe they don't need to take short rates higher. And the 2-year seems to be indicating that maybe there aren't too many near-term hikes in the cards. We're back to where we were. And all along, we've been saying maybe for, 6 months maybe, Roger, 1 or 2 more? And we're still, maybe 1 more. We're still stuck on that.
Well, we're stuck on it because, as the minutes themselves say, while inflation's come down, it's still very much above the 2% target. And the Fed said in the minutes that they want to be, I think they use the word, confident that inflation is, as they say, clearly on the path towards 2%. So the reason that we're continuing to get these hikes is inflation is still high. And as we've seen recently, there continues to be, in a positive sense, forward momentum in the economy, but that feeds through to imbalances that they're worried about. And so I think, yet again, we're in maybe a pause in September and 1 more after that, depending very much on what the data point out.
Roger, we nobody ever can see that far into the future. And the thing that scares me, I guess, is that maybe we're under, maybe we really, I've always been thinking that inflation would take care of itself after the supply chain issues went away. And I guess Robert Kaplan got me thinking about how much more money we do really have to spend with all these programs. And because now the narrative is there's not going to be a recession, or at least it's going to be a soft landing, what scares me is on the downside is we could have to go much higher, like back to the rates that I was used to my entire life, whether it's 6, 7, 8%. They didn't cut off the economy or the stock market back then. We did just fine with 7.5% and 8% notes. Roger, would you see that as a possibility that the Fed just has to keep going and going and going for the fever to break?
I wouldn't say going and going and going. I would say 2 things, though. First, the experience of the last decade or more, 2 decades almost, of very, very low interest rates was certainly, as you point out, an anomaly. It was not normal for money to be free. Secondly, we do continue to see, as they point out, these imbalances in the labor market. So I think that's one of the things that is going to drive them to be open to going further. So I think the way I would think about this, Joe, is certainly 1 more and the possibility, depending on how the data come in, of more than that. And the market, I think, has got to get its head around that concept. The reason I think the market was surprised is an expectation that the Fed is almost done. And the Fed itself keeps saying, look, it's not just that inflation has come down, it's the level that's still too high, and the need to be confident that it's clearly on a trajectory to 2%. So that, to me, says the possibility, as you suggest, of more work to be done. Right. Going, don't know. But I think it's just too early for the market to say, well, the Fed is done, or even too early to say 1 and done. I think it's very data dependent, and there's a lot of forward momentum here.
Well, if you try to paint a picture of a stock market that underperforms on a secular level for 5 years, let's say. And there have been some smart guys delivering alpha last year, guys that think that we could be, guys and gals that think we could be below historical yields or rates of return on the stock market for a number of years and not necessarily just keep making new highs like we're used to. That's the scenario that I could see that would cause that would cause financial assets not to perform well for 5 years if we're just underestimating getting all the way back to those higher levels if we need to. I hope not, like you. But otherwise, the Fed are they're geniuses and they stuck the landing. You know, no recession, interest rates go back down, stock market goes up, and we live happily ever after. Has that ever happened, Roger? I hope it does.
It has rarely happened. Let's hope it happens this time.
Okay.
The one thing I'd caution, though, is even if you get a soft landing, it doesn't mean rates coming back down anytime soon.
Right.
So,
okay.
you know, higher for longer still has got to be a mantra.